Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us now on the program is Sean Darby, Managing Director at Mizuho Securities Asia. Sean, thanks very much for being with us. So a pretty impressive day today, all sectors higher. In fact, it's been a hell of a week, really. It's the mirror opposite of what we saw last week, down 4% last week. This week, getting back almost all of it. What really happened?
Good morning. I think two things are happening in the background. One is that the bond market has done a lot of the easing already at the front end for the Federal Reserve. And the fact that we've had the whole yield curve shift downwards has been a monetary easing. So presumably part of the equity market is discounting the fact that we're already in a policy shift, quite an aggressive one. I think the second one, and it doesn't really necessarily come through in the CPI data now, but there's a lot of wind of deflation out there. If you look for everything from steel prices to gasoline to China export pricing, it suggests that we're going to get quite aggressive drops in the CPI coming into the Christmas period. So I think, in a way, for the equity markets, they've got a reasonably nice tailwind. You've got still, decent employment conditions. You can look through and see that there's going to be a much lower CPI print going in through Christmas. And by and largely, there's been a massive policy easing already, simply by where the shape of the yield curve in the United States is presently.
Brian was talking a short while ago about a piece in the Wall Street Journal indicating that Fed policymakers were considering whether or not to cut by either 25 or 50 basis points. And I'm wondering whether, when you look at overall financial conditions, that things are maybe a little too easy for the Fed right now. Much higher stocks and a big rally in the bond market. And maybe that's causing a little concern. What do you think?
I actually have a lot of sympathy with that view. If you look at some of the other developed markets, Australia and New Zealand, there the central banks would also like to do more aggressive rate cutting, particularly in Australia, which hasn't started yet. But the thing that's holding them back is house prices. And as you see these yield curves dropping, what you're beginning to see is the mortgage markets reigniting again. And this is going to go back and put pressure on CPI and the economy later on. So I have a lot of sympathy with the view that we saw a big sea change in monetary policy really after the regional banking crisis in first quarter 2023. And that in itself, I think, has been washing through the US and global economies since then. So if you look at Chicago financial conditions, it's been loose and remains very loose compared to where it was 12 or 18 months ago.
It's funny because when you started, you talked a little bit about how there are some deflationary conditions out there and that we've seen a big drop in commodity price and such, and that the CPI would be moving down. So I'm a little surprised to hear you respond in the way you just did. I was listening to Jim Bianco earlier this week, and he said that he would be more worried if you did have a rapid drop in inflation, because that would actually be an indication that growth is falling off, that inflation would fall that quickly. And so from a standpoint like that, he probably liked the numbers that we got this week, because it shows you that you still have growth kind of hanging in there while prices are moderating slightly.
So just to clarify, during the sort of deflation or disinflation period coming into COVID, we had exactly that, very, very low inflation, but very robust house prices and asset markets. So maybe the equity market is discounting that in some ways. The only difficulty I have with the Mr. Jim Bianchi's theories for equity investors, in the first instance, it may not be necessarily good news. What I mean by that is that bonds, of course, like the lower CPI prints, the lower producer price prints. But for equities, that's our corporate prices. That's how our revenues are generated. So you may, in the short term, get actually quite a big drop in profits simply because pricing has dropped away. And I think that's actually the major concern, I think, for parts of the equity market, is that you go from really good profits to just modestly good, which is what you've normally had for the last 15 to 20 years. And that, in a sense, may alter the course of this ascendancy in the S&P and other equity markets.
So disinflation, that's the story in the U.S. It's deflation in China. How concerned are you about the fact that China may be falling into a bit of a trap here that's going to be very, very difficult from which to emerge?
Well, I have a lot of sympathy with that. I think what's interesting is if you look at the Dutch Global Trade Organization, they produce export prices for China in US dollar terms, which are before tariffs. And goodness me, the numbers that have been coming out of China in the last 9 to 12 months have been exceptional, even in China's own modern history. So the first thing to say is that China's exporting its deflation into the system, and you can see that through tariffs coming onto steel and so forth. I think the second thing is that we all know that one of the ironies about deflation is it causes everyone to oversave. You get the very oddest thing happening to you, which is people actually go back and save more as the CPI prints get worse. And the only way you can counteract that is by someone in the system opening their balance sheet. As you saw initially in Japan, it was the government, and then later on, as we went through, this occurred in the West, it was the central bank. So at the moment in China, you could argue both the government and the central bank are too tight. And that's really why you're getting such aggressive levels of deflation. My own personal view is that if you look through China's history since the 1980s, 1990s, monetary solutions have always been the way out of their sort of fiscal problems. And I think it's going to be no different now. I think Pan Gong-shen will do his own form of QE if he's not already beginning to do it. And that's how China's going to resolve its issues. But yeah, point well taken. I don't think China's recognized just how bad and how fierce the deflation cycle has been embedded in the economy.
So are we getting anywhere near an inflection point where they do actually say, look, we really have to do something and do it in a big way?
Well, I think he's setting it out at the moment. He's trying to move the yield curve to 7-day repo pricing at the short end, bond and sales of government bonds at the long end. He's using moral suasion on the banks for mortgage rates. But ultimately, you've got to really expand that balance sheet and push the money into the system, because all I see at the moment is every part of the economy, households, corporates, all saving.
It's clenching up, yeah.
You mentioned Japan a moment ago. We got a BOJ meeting next week. Are they being maybe a little bit too conservative here? Is there a problem that they have to deal with and raise rates quickly?
That's a very good point. And I think, ironically, you could argue that is exactly the problem that they have. They have slowing growth, but actually rising inflation. And in that instance, given that the labor markets still look really rich in Japan, the path is to further tightening. The best way to look at it in Japan is that service prices, which are very well correlated to wage growth, are running at around 3.5–4%, and that's pretty uncomfortable for the BOJ. So it's got back inflation, but it's got back to a degree that the BOJ would never have imagined 18 months ago coming out of the pandemic. So to answer your question, the path of least resistance in Japan seems to be towards more tightening of the cash rate.
The elephant in the room probably is AI and some of these mega caps. You've seen a real bounce this week. You still have NVIDIA and Broadcom maybe 10% to 15% off their earlier highs from the year, but they've really come back. Is this a good sign in your view, or does this sort of bring back these issues of overvaluation?
Well, I think since we had the carry trade unwind, tech has rebounded. But what's really happened in the background is that the boring, low value and very, price sticky or price inelastic sectors like healthcare, utilities, to some extent banks, have all actually touched globally 52-week highs and also record highs. So out there, you could argue that the battle between the sort of growth and inflation is falling towards the view that we earlier highlighted, that actually prices may come down in the short term much more aggressively, and that the equity market's been thinking that actually we want to be in sectors that hold their pricing power, even though there are really good stories of growth out there. And I think that's the way the market's been making that assessment in the last sort of 5 to 6 weeks.
All right, Sean, thank you. You are a guy who's been with us for all of these 9 years. 2 thumbs up. Yeah, absolutely. In fact, Sean and I go back even to the RTHK days and way back in time. Sean Darby with us, Managing Director at Mizuho Securities Asia. Joining us in our studios right here in Hong Kong, old friend Mark Konyn, CIO at AIA Group, with us to take a look at markets. All of a sudden, the mood has improved from last week. In your mind, Mark, what happened?
I guess markets tended to be a little too reactive to the concern that the economy, certainly in the US, was slowing. I think there was a view initially that the inflation number wasn't as good as expected, although we felt that it was more or less in line with expectations. So there was a bit of a concern that perhaps that sort of rehearsal for potential recession was starting to play out. But then I think it regained its poise, and I think we're now much more focused on looking through the numbers and thinking about the impact of these rate cuts which are pending.
And how do you see the rate cuts playing out? What do you think? Which assets do you think outperform, and which assets do you think benefit the most?
Yeah, so if you look back at the last 10 rate cut cycles, it goes back to 1970. In 4 of those rate cut cycles, there hasn't been a recession following, and the market's done extremely well. The stock market has been up 8% over 3 months and 18% over 6 months after those rate cuts were initiated. We don't think that we're in line for a recession over the next 12 months. We think the economy is in good shape. We think the wage pressure has cooled. We think there are disinflationary forces at play, and we think corporate earnings are in pretty good shape. So if you look at history, the expectation is that the equity market is going to sort of be underpinned by good earnings outcomes, and that means the market's going to make further progress. If you look at the 2 main asset classes, equities and fixed income, bonds are really discounting, or look to be discounting, a recession, and that's going to have to readjust. So we think bonds are going to retrace some of the gains that they've made most recently.
So if you look at credit and you look at equities, it looks pretty rosy. And then if you look at the bond market, maybe not so much. One of the things that happens a lot now is that news gets discounted very quickly, maybe faster than before. So maybe Fed rate cuts already pretty much discounted in the markets. I don't know how you feel about that. Is that a possibility?
Well, certainly expectations are for something like 10, 11 or so cuts. We think that's overplayed, and we think the bond market has really focused probably a little bit too much on the near term, the reaction to the news. And as I say, the yield declines that we've seen will retrace by about 20 to 40 basis points over the curve. So that misalignment, if you like, between risk assets and bond markets has to be addressed, and it will do so. So in answer to your question, Brian, the bond market probably is going to go through a little bit of an adjustment near term, and equities will continue to make progress.
So, Mark, I will ask you what Brian asked me earlier. Are you concerned about valuations in equity markets?
No, because as long as earnings keeps pace, that's good news. If you look at productivity gains, and obviously putting aside different policy initiatives that may ensue after the election, it looks as though job creation is reasonable. You may be worried by the fact that a large portion of those new jobs are related to the public sector, but in a way that's good news for the private sector, because that means the private sector is still moving forward and becoming more productive, because the earnings are indeed forthcoming. So we do expect a broadening out of the equity market, supported by earnings. So valuations, no, not worried is my short answer. It's tricky though,
because we've had earnings up 10% this year, projections for 14% next year, and that's with a slowing economy. Now maybe it's not tanking, But even if it's slowing, how do you make the jump to get earnings up 14% next year?
Well, you're right, Brian. The economy is slowing, but it's very gradual. So the sort of disinflationary forces are at play. The opportunity for the Fed to cut is supportive of the broader economy. And don't forget, this is all in context of a massive fiscal deficit and ongoing commitment for fiscal spending. If you looked at the presidential debate this week, one thing you can take out of it is that spending is going to continue. So that's underpinning everything. It's very unusual to see rates coming down at a time when you've got huge fiscal expansion, but that is in fact the case. If you look at the US Treasury market, per annum, that's paying out in coupons about $1.2 trillion. Unbelievable amounts of money.
So we're spending it, aren't we?
Exactly, and it's being spent. So depending on policies as we roll through the election, on one hand it may be a little bit more expansive for the average consumer. On the other hand, it may not be. But overall, consumption is in reasonable shape, and even the property market is starting to cool, and its representation in terms of cost base is starting to pull back. So overall, in good shape. The economy is being extremely well managed.
So, Mark, let's talk a little bit about the budget deficit. You mentioned, is it something we should be worried about, or is it only something we worry about when it comes time to worry about it?
Well, there clearly are going to be consequences. We're going to see the usual political rankering as budgets are being promulgated and need to be approved as is required. It's probably good news for markets in this part of the world as you see rates come down and investors focus on issues like the deficit. The dollar will weaken, and that will probably readjust fund flows globally.
Okay, perhaps a tongue-in-cheek question. Former President Trump didn't perform too well in this latest debate. Do the Republicans replace him?
Certainly tongue-in-cheek. How performance is gauged depends on what you're trying to achieve. So it's difficult to read, but we try and look through the debate and focus on the policies, and there are some clear differences between the two.
Yeah, there are some that would say that the former president, performed as badly as President Biden did in his debate, but that was kind of a tongue-in-cheek question, and you played ball with us, Mark, as usual. Mark Konyn with us from AIA Group. This is Bloomberg. I'm Brian Curtis in Hong Kong, along with Mary Nicola in Singapore. Let's say good morning to our guest, Louis Kuijs, APAC chief economist from S&P Global Ratings. Well, we got a lot of time here, Louis, that we can cover a number of economies around the globe. Let's start off with the U.S. because we've had some data of late. We had Janet Yellen earlier saying that there weren't any red lights flashing in the U.S. economy. Do you agree? And is your reading that investors should be nervous about recession possibilities or not so much?
Hi, Brian. Yeah, so, the U.S. economy is cooling, and we see that in some of the economic activity data and even, especially also some of the labor market data, fewer job openings. But in our assessment, we can definitely not rule out a recession, but there are no signs that there is a very significant reduction in growth, let alone, a path towards a recession. So we don't think that the U.S. economy is moving into a recession.
So the big
Mary?
The big question now is it 25 basis points or is it 50? What camp do you fall in?
Yeah, I think for now we are falling in the 25 basis points camp. There is no great rush for the Fed, right? Like they need to make sure that they don't have to do U-turns in this trajectory. So we kind of all agree that that broadly speaking, U.S. rates will come down, but we don't yet know, and they don't know either, because we don't know the data. We don't know how fast and when it will be, at its terminal rate. So I think they will err on the side of making sure that they don't have to do U-turns. So I think 25 sounds about right.
And Louis, does it feel like they have some time here? I mean, we know that the Fed funds rate at 5.25% to 5.5% is well above what is perceived to be the neutral rate. So there is some room there, and there's also some time. Do you do it quickly, or do you just kind of let the data advise?
Yeah, so I think that the officials in the Fed who make these decisions, they meet pretty regularly, so they will have quite a number of opportunities to make further cuts, right? And so I think, given that the most recent data on inflation wasn't that soft, I think that the markets sometimes seem to be pricing in a lot of cuts. We definitely are in the camp of cuts, but we don't expect as many cuts as the market.
So let's shift gears a little bit towards China, a little bit closer to home. Obviously, the data from China has been incredibly disappointing. Where do you see the economy headed over the next 6 to 12 months?
Yeah, so the news in China is not good, right? Like the only component of demand, as we call it, that is doing well is exports. Anything related to domestic demand is looking pretty poor. The housing downturn continues to be a huge drag on the economy, and that is affecting things not just directly, but also in terms of confidence, and people worry about the price fall. So we have weak consumption. We've been having, of course, weak real estate investment for quite some time. We now also see some cracks in investment outside of real estate. So overall, really soft economy. And then we have a government that doesn't seem to be having a lot of appetite to ease fiscal policy. And so our outlook is for economic momentum to soften further in the second half. And we expect, on current trends, China to miss its 5% growth target this year. So we're looking at, a bit around 4.5, 4.6% growth this year, a bit below that next year.
It makes for some interesting reading, the latest from the IMF about U.S., China, and U.S. with its claims that overcapacity is definitely hurting countries, that China is dumping, in a sense, a lot of its industrial overproduction. The IMF report suggests that this really is not the case, that a lot of the exports from China, that they account for a very small amount, these areas of software, electric vehicles, computer chips, green technology, that they're a small fraction of overseas shipments. Do you care to weigh in on this debate at all about overcapacity, Louis?
Yeah, sure. Happy to make some comments, Brian. I think we already touched on the weak demand in China, and I think, the Chinese manufacturing sector is huge. It's also very competitive. We cannot get around it. That's a very competitive manufacturing sector. It's very rich in terms of a huge landscape of suppliers, labor markets that make that a very competitive manufacturing sector. So even without significant subsidies, this is hard to compete with, and that is what we are seeing globally. I think the problem in China is a macroeconomic one. Demand is very weak compared to supply, and so for China to, reduce the pressure both in terms of its own deflation risk and the pressure on profit margins, but also reduce the pressure on the global economy in terms of all these exports that are making life hard across the globe. I think the way to solve that would be for China to improve, to boost its own domestic demand, so that all these exporters have less of, all these manufacturers have, less of a need to venture abroad. And I think secondly, also there's something needed, more discipline in the financial sector and among companies, because, people outside of China often talk about, as you said, Brian, big subsidies. A lot of this is not so much driven by government subsidies, but it's much more companies that are able and willing to produce with extremely low profits, sometimes even no profits. And there seems to be a patience for that, both among these companies themselves and their creditors. And that, of course, is also a reason why we see these what we tend to call excess capacity, but that is often a reflection of the business strategy of these companies.
So, Louis, just before we round up on China, just a quick question on local governments. So we had a piece out on the terminal this morning about local governments turning to austerity. This is probably something we see as a good thing, but have they gone too far the other way? And where's the right balance given the weakness in growth?
Yeah, I think something that we see in China more so than in other countries is an unfortunate situation where when demand in the economy is weak, the government behavior, like fiscal policy, kind of starts to add to it. You would want what you would want, right? And that is what Keynes became famous for. If there is very little appetite for spending among the private sector and households, you want the government to spend as a spender of last resort. In China, that's often the other way around. In difficult times, local governments and other government departments are asked to tighten their belt, and that is actually aggravating the situation from that macroeconomic perspective. And that is, from a macro perspective, quite unfortunate.
All right, Louis, thank you very much for joining us here on the program. Louis Kuijs, APAC Chief Economist, S&P Global Ratings.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.